Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hira Dadia. We have with us Shachindra Nath, Executive Chairman and MD at UGRO Capital, joining in. Shachindra, welcome to the show and a pleasure to speak to you.
Thank you.
Shachindra, my first question coming to you is, taking into consideration that you have been in the lending industry, how is the MSME lending space shaping up from here on, especially taking into consideration that we've crossed two waves already? I don't know if we can still call it post-pandemic or not, but for the time being, taking that things that, the number of cases of COVID are going down, how do you see it moving from here on?
So I think it's in half glass full, half glass empty story, right? So one, I don't think so that anyone should be in this this view the pandemic is over. This pandemic is here to stay. I think so. Its veracity and intensity has definitely lowered. But unless we have a 80% plus population vaccinated, you always have a real possibility of it coming back. With respect to MSME, I think so let's take a little step back and look at a macro view. MSME in India, they contribute to almost 30% of our GDP. They provide employment to 11 crore plus people. If India has to continue growing at even at the rate of 7 to 9% of GDP, the MSME contribution have to grow from current 30% base to 40 odd percent. Employment has to grow from 11 crore to 20 crore. Most of the time, what is hindering its growth is the availability of the credit, because the historical way of how credit for small businesses has been given has been a very difficult challenge. Obviously, when the pandemic has hit, those problems have become much more acute, because most of the lending institutions are worried about the reduced cash flow, and that's why the availability of credit is also get reduced. And that's also a fact that within the broader industry, it is the small businesses which got affected very severely. Almost 85% plus small businesses in India were affected by SME and reduced cash flow. But simultaneously, the entrepreneurial zeal which a small business have brought them what we call a very sharp V-shaped recovery. We have seen through our portfolio both first round of pandemic and second round of pandemic, that as their revenues go down very sharply, but they also come back very sharply. So we are seeing a very serious rebound or a V-shaped recovery happening, and there is a catch-up happening. And I think so that is the point of time wherein we are expanding our credit dissemination to them. We have used the pandemic period, as you know, that UGRO is designed to build India's largest small business financing platform. We intend to serve 1% of the market share, roughly around 500,000 plus small businesses in India. And as a new platform which is funded by such a large capital, we have used all of these time to build our infrastructure, both technological as well as physical infrastructure, so that we are ready to embrace and service more and more SME customers. And we have seen that if you look at our July of the current month has been the highest ever disbursement since we started our journey.
Right. So with all of this, what is going to be UGRO's strategy to capture the available market share? Because clearly, with regards to disbursements, it's an interesting trend that we are seeing with UGRO, whereas with a lot of other companies who are into the lending business, disbursements have been slow. They have tightened their processes as well. They've gone ahead and made their eligibility criteria stricter. So what is the strategy that UGRO Capital is using?
Yeah, so I think so that those are all right steps. We have also done the same. Yeah, but I think so what differentiates us and why we are, so one, obviously there is a latent demand. Second, fortunately for us, we got capitalized of around 950 odd crore in July of 18. We started this platform in April of 19. So we have the requisite base of capital and very serious liquidity available to us. So this itself differentiate us with many other lenders. Second, we are dedicated to this segment of the market. So we don't do any other segment. So that means that we are much sharper in terms of our understanding. Third, we are focused on our sectors and subsectors. So we focus on 8 sectors, we focus on micro, and within that we focus on 100 subsectors. So our assessment and understanding of minute subsectors is much sharper. And last but not the least, it is the base effect, because We have 4 asset engines for us. We have a branch-led channel, which services the prime and micro customer. In this period, we have expanded our branches. We added 25 branches. We are adding 15 more. So that is helping. We have an ecosystem channel which takes care of very large supply chain financing business plus machinery. Our machinery financing business started during the pandemic and now it's coming to scale. Our supply chain business is completely digitized technology and we are now integrating with large ecosystem. Third, we started more or less during the pandemic a channel called Partnership and Alliances, wherein now we have integrated with roughly around 16 plus underlying partners, which can be a small NBFC, fintech, payment platform, so on and so forth. And that is now growing. And by end of this year, we'll start a fully digital channel as well. So that's the asset channel. And also the liability side. We are the one who have been able to, during this period, have been able to do marquee partnership with Bank of Baroda. We are added almost 40 plus lenders now on our balance sheet. We are an under-levered platform and there is a significant cash available to us. So all of that is helping.
Right. So taking this into consideration and talking about your distribution channel, what are the key niche industries that we are focusing on right now?
So we focus, as UGRO, if you look at from a design perspective, UGRO is focused on select sectors. Under the select sector, we have 2 core principles. One is our data analytics and digitization, and then second is analytics. Second is our technology platform. In terms of sector, from day one, we are focused on 8, which is healthcare, education, auto component, chemical, food, beverages, hospitality, light engineering, electrical equipment manufacturing. And also micro enterprises, which is sub 15 lakh loans. And within these 8 sectors, then we have 100 plus subsectors.
Wow.
In the way we designed our underwriting is purely, largely for our main prime market. We look this tripod of GST, banking and bureau, and our data analytics platform design underwriting on top of that. And that helps us to automate credit. And then depending upon customer type, it can be a collateral and non-collateral based financing. Majority of our current portfolio is collateral based financing, and gradually we are looking at more cash flow driven financing. So merchant financing, cash flow led financing. We have integrated ourselves with Gem Sahai, so on and so forth.
Right. So any newer segments of business that we are looking to enter?
Ma'am, we are already, our sectors cover almost 60% of MSME market in India. That's large enough. Our 5-year goal by 2025 is to take 1% market share, 20,000 crore of asset under management within the broad sectors and subsectors and micro MSME, which is sector neutral. I think so we have enough to do right now. We continue to evaluate. So we have looked at the entire universe of 180 sectors. We have filtered to 20 and then we filtered to 8. So this transition from 8 to 20 would happen at some point of time, but right now we are focused on what we are doing.
Right. And from a business perspective, the interest yield has increased substantially to 15.8% in the first quarter of FY22. If you could just help us understand what is it that's driving this kind of an improvement, number one, and number two, is this something which is sustainable?
So if you look at the construct of how we are different than a lot of other fintechs who we are now balance sheet provider, majority of the fintechs, because of their relatively lesser size of capital, they focus on purely unsecured financing, which ranges between 18% to 35 odd percent. And that's why their gross yield always remain higher. We look at this as more as a matter of, because we are not just a marketplace, we are also a provider of principal capital and there is lenders to us. So we have made sure that in our initial period of build, our majority of our portfolio come from prime secured businesses. And most of those portfolios are in the gross yield range of anything up to 12 odd percent and not beyond that, because that's the nature of the prime customer. Gradually, as we are getting comfortable with our data analytics, with our underwriting, with our collection, newer segments of the market are getting opened up. So for example, we have launched micro MSME. So micro MSME customers obviously comes at a higher yield. Our entire partnership and alliances channel comes at little higher yield. So gradually, we are seeing a little bit of uptake. I think so. For foreseeable future, next 12 months or so, the yield band in which we are operating would continue to be the same.
Right. And overall, moving from there on, if you see in terms of the cost of debt as well, that's been in the range of 10.4 to 10.5 for the last 3 to 4 quarters. How do you see it moving from here on? Because again, a lot of companies who are into the lending business have tried getting their cost of funds lower in that 8 to 9% bracket already.
So I think so if you analyze us by vintage, our cost of borrowing for our vintage is already superior by at least 150 to 200 basis point. So companies which are of our vintage, which is 3 year plus, would be at much higher cost of borrowing. I think so it is a matter of pride for us, given our quality of governance, size of capital, and strong underlying business model, that sequentially it has been coming down. Our focus is not to really all the time optimize our cost of borrowing. We rather optimize on the asset side, but more so we are also very deeply focused on our co-lending platforms, because our view is that future of NBFC is not leveraging the on-balance sheet asset, because it's very difficult. Lending or the liability universe is very small in Indian market, when largely your liability is dependent upon term financing from public and private sector bank, some bit of capital market. But we are focused on co-lending, which is an off-balance sheet asset, which is much more profitable than actually on balance sheet. We are focused on term financing, where the costs have been coming down sequentially. It would remain in the same band. And third, we are also focused on securitization of our asset. And last but not the least, we think so that there is a large pool of capital available, which is within the world of multilateral and DFIs. Given 99% of our asset creation is in priority sector, it's impact financing, we generate employment, women financing, clean energy, that pool of capital would also be available to us within the same price band or little lower, but for much longer tenure. So I think so we are in one of the very strongest position to create the franchise for which we have stated our mission.
Right. And what's the trend looking like in terms of where the asset quality goes from here on?
So we have, as I said, that philosophically, because in our early period of time, we continue to keep focus of keeping large portion of our portfolio in prime category. What I define by prime category, it is customer which is either in a bureau band of CMR 1 to 4, or individual score of 750 or 700 plus, and have a high quality collateral to offer. Obviously, that kind of a customer come with a lower yield, but we are okay with that lower yield portfolio to be combined with little higher yield unsecured portfolio, but keep the ratio of 70-30, which is visible today, in the same fashion. And our view is that if you continue in this trajectory, your portfolio quality will remain strong. So if you look at post two pandemic round, we are still at roughly around 2.3% of gross NPA, 1 some percentage of net NPA. If you look at our entire restructured pool as well, it is not more than 7.5% of our entire portfolio, and it will keep coming down. Even if you look at our type of our restructuring, most of it is no moratorium given to the customer. It is largely cash flow adjustment. If you're paying a 5 lakh rupees of EMI, your cash flow has become half. We have readjusted your EMI to 3 lakh rupees and increased the tenure of your loan. So it's just matching the cash flow rather than creating a tail end risk onto a portfolio. And I think so if we continue on this journey, we would create a very healthy portfolio for ourselves.
Right. So right now, how does the collection efficiency look like?
So look, collection efficiency for small businesses has to be always contextualized in the sense how the actual cash flow for the small business have been. And as I said, that while it drops very significantly, it also recovers, with the same pace. So if you look at July data, our collection efficiency is back to 97 odd percent. So it's very strong. But in both in April and May, it dropped significantly, went down to 75 odd percent. And we think so that's normal, because majority of the small business customer, they were not being able to collect their payments. They were dysfunctional. So unless we see a very sharp, deep shutdown, lockdown happening again, even with the COVID disruption, I think so we'll be in the same collection efficiency range.
Right. And overall, in terms of the disbursements and AUM as well, we've seen a substantial growth over the last 24 months. How big a role is technology playing in terms of where the company's growth is concerned? because now majority of the fintech companies are also, I mean, financial companies are also adopting technology to see growth. If you could just help us understand the same.
Three things. First, I think so we are also as fintech as any other fintech in the country. We tend not to say that we are a fintech, because fintech is a means, not an end itself. For us, technology is pivotal to everything we do, and without that, in current future becomes very challenging if you're not deeply tech and analytical oriented. Number two, what we are calling as a significant growth, you have to start thinking that this is a company which started with cash capital of 950 odd crore. It took 7 months to build its system, process, distribution, technology. And that's why in the first year, it predominantly disbursed its capital. And in the second year, it disbursed half of the first year while it was functional, or almost same amount while it was functional only for 5 months. So the growth which you're seeing is nothing but our natural progression of very heavy early time investment in our people, technology, and distribution. And we think so that we will continue to be on the same path. We actually believe that our AUM, what you're seeing today, is actually 50% of what it should have been. And that is because we have a complete 1 year of disruption or a shutdown. But now we are trying to capture that back. If you look at our March disbursement, which was 130 crore, June, when we were functional for 12 days, it was 136 crores. July was roughly around 210 net AUM increase, and it will gradually keep going up. So I think so we should look at doubling the AUM or more than that in current year.
Okay. And overall, with all of this, again, we've said that in the next 5 years, we're looking at a 20,000 crore AUM. Now, what is going to be the strategy from here on to reach this kind of a number?
So, ma'am, you have to look at this. There are a few pillars to that. So we have 9 or 15 plus prime branches which services prime customer, and that's the volume leader. We have micro channel which services sub 15 lakh rupees loan. We have started 25, we are adding 50. It will go up to 250 or to 300 plus, which will add significant amount of AUM to us. We have an ecosystem and supply chain business where we are one of the most digitally integrated platform. We are on almost all digital platform. We have very large base of anchors, so that would continue growing, and that's where we are experimenting all of our cash flow based financing. We have also a channel which looks at productive asset financing, which is machinery, which we believe will become much larger given the manufacturing output in India for SMEs is growing. And our partnership and alliances and digital channel continue to grow. So given in our first 2 years, we have built the base which services the need of every MSME customer in India, both from geographical reach and also product reach. If God would remain kind on to us and we continue to get our liability and maintain quality of portfolio, we are just doubling our AUM every year and we'll reach that milestone.
Right. And with regards to debt to equity, we are below that 1 time as of the first quarter of FY22. We are at 0.84 times. We are pretty under leveraged. So is this something which we will be able to continue from here on?
No, ma'am. No lending institution with this kind of an under leverage can make money. But we are very clear that the older time of NBFCs over leveraging themselves and creating an ALM mismatch, so the ROA and ROE tree were driven by ALM mismatch and over leverages, right? That is not coming back. So any lending platform whose business model is designed only for leverage would not sustain and survive. Our view is that the maximum leverage which you'll see is not going to go beyond 4 times because market would not accept it. If you look at our 20,000 crore construct of business, we have very clearly said that 10,000 crore is on balance sheet, 10,000 crore is off balance sheet. Of that balance 10,000 crore, 50% or 60% near about would be in our co-lending and balance would be securitized assets. So we are targeting to generate same, top quartile ROE of 18% plus, but without creating massive leverage on our balance sheet.
Right. And overall, very lastly, in terms of where your partnerships go, you've recently operationalized your partnership with Bank of Baroda for co-lending. If you could just help us understand with regards to the co-lending model with large banks, and what is going to be, UGRO's vision in operationalizing such partnerships? How many more in the pipeline?
So I think that's a little bit of our secret sauce. So I don't want to divulge too much, but let me say this, that banks, especially the large banks in India, are a little tired giving very massive term lending to the NBFCs because of the counterparty risk which they have suffered from. Because when they lend to large NBFCs, they lend it for one purpose, the money is utilized for something else. And that's why this new regulatory framework of co-lending has been brought, so that the underlying customer asset belong to the bank and NBFC jointly, rather than bank just giving balance sheet led lending. The challenge though have been that it is operationally very, very cumbersome. So to give you an example, it's taken us almost 1.5 years to operationalize our partnership with Bank of Baroda, because these are two different sets of institutions. One which has 100 years of embedded method of doing an SME financing, and second is a new generation NBFC. Good thing is that what we have seen, because of our perseverance and persistency, most of the large financial institutions have now accepted our credit models, and we have been able to operationalize it, both from they accepting our credit model, but also integrating through technology, where in every loan case, we go originate, underwrite, lend it through a common lending policy on our balance sheet, and then the loan get downsold in form of a securitization to a bank partner. And I think so that would continue to be the NBFCs which will not focus on this would actually find it very difficult to continue growing.
Right.
Second, in terms of how many banks, our approach is that we have different product suites. And for a different product suite, there will be different lending institution. We are not a marketplace per se. So it's not that we generate 10 loans and there are 10 banks and they compete for those loans. For every type of a customer set, there will be a lender is our aspiration. So for example, with Bank of Baroda, we have a product called Pratham, which is first, which targets the really prime customers, CMR 1 to 4, where we lend at a very fine rate and compete with almost all mainline lenders. Whereas for the machinery, we are partnering with somebody else, on supply chain with somebody else. So we would rather partner with 5 or 6 large institutions and then focus on our energy in creating good quality asset for them.
Right. I mean, that looks like a strong strategy that UGRO is focusing on as well. All right. Thanks a lot, Shachindra. Thank you so much for speaking to us at Nirmal Bang. Pleasure getting insights from you about the industry, how growth could look like for the company as well. Seems to be like an onwards and upwards journey as well for UGRO. So congratulations once again, and stay safe and speak to you soon again.
Thank you. Thank you.
Thank you so much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.